Everyone thinks they understand. They believe the 2008 crisis was the final lesson. They trust that the Federal Reserve, Fed, has figured out how to patch the system. But right now, a mysterious and eerily accurate omen is sounding alarms that would send shivers down the spines of the most seasoned financial veterans. And this time, it's not just a crack. It's the great earthquake building beneath the surface of the global economy. An earthquake that makes 1,929 look like a gentle tremor, and 2008 seem like a warm-up act. They call it the inverted yield curve. To most people, it's just another boring, dry economic term, irrelevant to their daily lives. But did you know? Every single time this pattern has emerged over the last 50 years, it has predicted every major recession. Not some of them, not most of them, but every single one. It's not the cause. It is the market's alarm system, a natural chemical reaction indicating that something is fundamentally wrong with the financial order. And what is most terrifying is that the current warning pattern is being amplified by three factors that never existed before in history: unlimited debt, hyperspeed transaction velocity, and the exhaustion of traditional rescue tools. Today, we won't talk in theories. We will decode this ultimate warning signal. We will look past the deceptive stability to see the forces being built underneath. Forces that are more complex, interconnected, and explosive than anything we have ever seen. This is not a prediction of when the collapse will happen, but a detailed map of how and why the coming collapse will be fundamentally different, and why it may change not just your portfolio, but our society as a whole. This is an analysis that demands your full attention. If you want to be one of the few who is not swept up in the coming storm, if you want to understand the real rules of this economy, you must watch until the end. Now, let's start with the basic mechanism. What exactly is the yield curve? 1. Interest rates and the time risk premium. The most fundamental principle of finance is this: the longer you lend money to the government, the higher the interest rate you should receive. If you lock up $100 for 30 years instead of 2 years, you must be compensated for the risk of inflation and the opportunity cost over that 28-year difference. This is simple supply and demand theory, and it creates the normal, upward-sloping yield curve. 2. When water flows uphill. When short-term interest rates, for example, 3 months, 2 years, rise above long-term rates, 10 years, 30 years, the natural order is flipped upside down. It is like water flowing uphill. What triggers this paradoxical phenomenon? It is fear. Large investors, pension funds, and multi-billion-dollar institutions become so terrified of the near-term future that they are willing to accept lower returns from 10-year or 30-year bonds. This action is not investing. It is fleeing. They are pulling capital out of risky investments, stocks, corporate credit, and rushing into the absolute safe haven of long-term government bonds. When the demand to buy long-term bonds surges, their price goes up, and by the inverse rule, their yield goes down. Simultaneously, the Fed's tight monetary policy pushes short-term yields up. The result: a complete inversion. 3. The most reliable signal. This pattern is not just a technical indicator. It is mass panic disguised as a data point. History has proven it. The inversion is the market's expectation that the Fed will be forced to aggressively cut interest rates in the future. That is to say, a recession is imminent. To stimulate the economy. Since 1970, every sustained inversion has led to a recession within 7 to 24 months. Its reliability is nearly absolute. And this is why the 2022 to 2023 inversion is such a colossal issue. It is screaming about what is to come. Part 2. Recurring historical lessons. The contagion webs. 1. The Great Depression, 1929. The simple web trap. Let's go back to 1929. The yield curve inverted in early 1928, nearly 18 months before Black Tuesday. The stock market was then at the peak of its frenzy, driven by the conviction that prosperity would last forever. But the financial system at the time had built a dangerous, albeit simple, web of risk. The 1929 web. The core of the 1929 disaster was the contagiousness of confidence and margin debt. Banks lent money to speculators. Speculators used that money to buy more stocks. Stock prices rose, making the bank's collateral look safe, encouraging them to lend even more. It was a positive feedback loop built on the illusion of value rooted in debt. When the Fed tightened policy and the loop was broken, the collapse did not happen in one place. It shattered everywhere at once. The failure of one bank in New York might have taken weeks to spread to other regions, but it drained the confidence in capital, leading to a decade-long credit contraction. 2. The global financial crisis 2008. The opaque web. The yield curve repeated the exact same omen, inverting in 2006, but this time, the risk web had evolved into a more sophisticated, opaque system. The complexity was not in stock-buying loans, but in securitization. People believed they had found a new way to diversify and distribute risk, but in reality, they created a diffused, ticking time bomb. The 2008 web. Subprime mortgages from borrowers who couldn't afford repayment were packaged into complex products called CDOs, collateralized debt obligations, and CMOs, collateralized mortgage obligations, then sold globally. Banks used these as collateral for further loans and then bought credit default swaps, CDS, from companies like AIG to insure these products. When home prices stopped rising and borrowers defaulted, the entire chain collapsed simultaneously. The fact that the bad debt was commingled and obscured within complex products meant no bank or institution truly knew the full extent of the risk they held. This was a disaster of hidden interconnectedness. 3. The current inversion. The hyperconnected web. Now, we are watching that movie a third time, but the script has been rewritten by technology, globalization, and unprecedented monetary policy. The 2022 to 2023 yield curve inversion is not just warning of a recession, it is pointing to an interconnected web that, if it breaks, will cause a far more catastrophic chain reaction. This time, the complexity is hyperconnected and instantaneous. We are facing a system where a single failure can trigger a cascading collapse with virtually no time delay. Part 3. The 3 pillars of threat. I. The pillar of failure. Infinite debt and mispricing. While the debt in 1929 and 2008 was manageable relative to the economy's size, today, we are drowning in obligations that can never realistically be repaid. The increase in government debt is alarming, but even more worrying is corporate debt. Over the 15 years of the cheap money era, companies did not borrow to build factories or invest in R&D. They borrowed for share buybacks, artificially inflating stock prices and executive bonuses. As interest rates rise and credit dries up, these companies don't just face higher servicing costs, they realize they have forgotten how to generate profits from actual business operations. The entire economy has become addicted to cheap credit, and any tightening will send it into shock. 3. The pillar of exhaustion, the spent playbook. This is the most critical and frightening factor. After 2008, the Fed used up the entire rescue manual. They kept rates near zero and injected trillions of dollars into the system. Quantitative easing, QE. This did not solve the debt problem. It merely postponed the reckoning by creating bigger asset bubbles. Now, as the inverted curve screams recession, they lack the capacity for significant rate cuts because rates were already so low. Governments, equally indebted, cannot afford massive spending increases. The toolkits of 1929 and 2008 have been exhausted fighting smaller battles. When the crisis hits, the system will face it with an empty arsenal. Part 4. Global fallout and the socio-political toll. 1. Exporting crisis and the dollar's collapse risk. The US dollar's role as the global reserve currency creates a unique layer of global risk. When the Fed rises rates, it doesn't just affect the US. It exports inflation and triggers currency crises in developing and emerging nations. These countries borrowed in dollars during the cheap money era. As the dollar strengthens, their debt servicing costs skyrocket, pushing them to the brink of insolvency. A collapse in the US financial system will not only be an American problem, it will lead to the fracturing of global supply chains and the disintegration of decades-old trade relationships. 2. The betrayal of trust and moral hazard. Perhaps the most dangerous element is the psychological breakdown. The current generation of investors has grown up in an environment where the central bank always intervenes to prevent any significant decline. They have been trained to believe that someone will always step in to save them. This moral hazard has encouraged reckless behavior. Pension funds invest in junk bonds. Retirees buy risky growth stocks. When the system finally breaks, these people won't just lose money, they will lose faith in the institutions that encourage that behavior. The social contract that says work hard, save money, and trust the system will be exposed as a fiction. Part 5. The harsh reality and the final call. 1. The statistical cover-up and real misery. Do not look at government reports and strong labor market figures. They only measure what is convenient. Unemployment rates appear healthy, but they exclude millions who have simply given up looking for work. The so-called gig economy is celebrated as innovation, but is, in reality, desperation masked by marketing language. When full-time jobs with benefits vanish, workers cobble together multiple part-time gigs just to survive, without a safety net, and without a path to building wealth. This real misery is the fuel for social and political instability. 2. Mathematics, history, and human nature. The yield curve never lies, and it is screaming that everything we have been told about financial stability is fiction. This is not doomsday prophecy. It is mathematics, history, and human nature converging into an inevitable collision. The coming crisis will be the culmination of all the mistakes from previous crises, amplified by technologies and policies that have removed the natural limits on financial excess. The question is not whether this crash will be worse than the previous ones. The question is whether the institutions and relationships that hold society together can survive the impact. If you have watched this far, you are among the few who are ready to face the truth. This is the time to act. Educate yourself, prepare, and diversify. In the world of finance, knowledge is the ultimate safe haven asset. Do not be passive. The choice is yours.